You know, folks, it was supposed to be the perfect storm. The great exodus from money markets was on the horizon. We had the Federal Reserve slashing interest rates and stocks rallying upward in a gallant wave of optimism. Financial analysts strutted around confidently, claiming investors would pull their money out en masse and flood the ever-vibrant stock and bond markets like bees to blooming flowers. Well, guess what? They couldn't have been more wrong. In fact, it's quite the opposite, ladies and gentlemen, because money market funds, MMFs, continue to grow, and they're sitting on a staggering $7 trillion milestone, the highest ever. What in the world's going on, and what can we learn here about the economy that you, me, and everyone else are actually living in? Let's break it down. First, it's important to understand a crucial narrative that's been fed to us all year long. Wall Street's pundits, like BlackRock Financial and Apollo Global, told us once the Fed lowered interest rates, it would be a goldmine for the stock market. The logic was simple: low interest rates compel people to take on more risk, and, supposedly, money would flow from safe investments like MMFs into stocks and bonds. Households everywhere were predicted to jump onto the stock market train. Yet, that never materialized. While rates did fall, especially as the Federal Reserve's emergency brake to curb inflation came into effect, we didn't witness the exodus that was predicted. Instead, cash poured even more aggressively into MMFs, surpassing the $7 trillion mark. Now, why? What's behind this contradiction? At the core of the matter is simple economics, people. 5%, as a benchmark return with virtually no risk, is an incredibly attractive offer in 2024. After years of near-zero returns in the money markets, especially during and after the pandemic, returns above 5% were a gift from the heavens. Investors, many of them retail households who have learned to live in a world of paltry interest rates, weren't going to snub their noses at that. Even when the Federal Reserve gradually slid those rates down to around 4.5%, this remained an incredibly attractive return compared to a decade of practically zero yield returns. A 4.5% yield? With little risk? Who's giving that up, especially in comparison to stocks whose volatility and uncertainty can lead to sleepless nights? Exactly. Nobody. Now, let's put the spotlight where it belongs, to money market funds and their sheer prominence in today's financial landscape. These aren't just any old funds. They've essentially transformed into the go-to for both companies and households to park cash, and for very good reasons. With global economic conditions deteriorating, rising geopolitical tensions, supply chain disruptions, and labor market instability, we're in a shifting environment. People are nervous, and they have every right to be. Long gone are the days when we could assume that the economy functions like clockwork. Today, the underlying instability is inescapable. This has led both institutional investors and retail investors to prioritize safety over riskier ventures. Currently, you can park your cash in MMFs and earn steady, competitive rates, without the fear of depreciation that would come with, say, a stock market crash. Let's not ignore how banks have dropped the ball here. Many of our trusted banks were slow, and I do mean slow, to respond to the Fed's cuts by passing those same savings on to consumers. Let's look at Goldman Sachs Marcus, whose high-yield savings dropped to 4.1%, lagging behind Treasury bills and MMFs offering 4.55% through overnight repurchase moves. That's right, folks, you can barely find a savings account offering 4% anywhere today, all while money funds offer 4.52% on 3-month Treasury bills or more. The result? Investors followed the money and doubled down on money market funds. $91 billion in just 1 week in November 2024. It's crystal clear where the smart money has been flowing. The pandemic reshaped more than just our online shopping habits, it radically altered how companies think about liquidity. Businesses are holding on to massive cash reserves post-pandemic, pouring liquidity into money market funds to take advantage of these incredible rates. This is something that should worry us and, frankly, the Federal Reserve. Corporate treasurers aren't fools. As rates are cut, they still want to squeeze out as much yield as they can get their hands on. And why not? Rates are high, inflation continues to hold steady, and businesses want to hedge their bets when it comes to future earnings losses due to economic instability. Yet keep in mind, businesses are not structured to leave this cash untouched forever. Many experts believe this oversized cash funneling into MMFs may dry up once rates drop closer to 2%, the point at which managers believe the easy money-making window slams shut. On one hand, sure, savers, especially those parking their cash in MMFs, are seeing unprecedented yields in recent history. But on the other hand, this mass hoarding of cash in low-risk investment vehicles has economic consequences that aren't easy to unravel. Money markets, while seemingly low risk, are still part of the broader financial system. An excessive cash concentration in MMFs diverts capital away from productive economic activities, raising concerns about insufficient long-term capital investment. Think about it for a moment. Institutions and retail savers alike are hoarding their resources rather than investing in innovation, technology development, or infrastructure expansion. This exacerbates a well-known issue in the U.S. economy, declining productivity growth. At a time when we should be investing in the future, green energy, AI innovation, automation, the money's tied up earning a safe 4.5%. We're living in opposition to the so-called animal spirits that Keynesian economists like to talk about. Investors should be reinvigorating the economy with active capital deployment, but instead, cash is buried deep in the vaults of MMFs earning a boring but consistent 4.5%. On one hand, sure, savers, especially those parking their cash in MMFs, are seeing unprecedented yields in recent history. But on the other hand, this mass hoarding of cash in low-risk investment vehicles has economic consequences that aren't easy to unravel. Money markets, while seemingly low risk, are still part of the broader financial system. An excessive cash concentration in MMFs diverts capital away from productive economic activities, raising concerns about insufficient long-term capital investment. Think about it for a moment. Institutions and retail savers alike are hoarding their resources rather than investing in innovation, technology development, or infrastructure expansion. This exacerbates a well-known issue in the U.S. economy, declining productivity growth. At a time when we should be investing in the future, green energy, AI innovation, automation, the money's tied up earning a safe 4.5%. We're living in opposition to the so-called animal spirits that Keynesian economists like to talk about. Investors should be reinvigorating the economy with active capital deployment, but instead, cash is buried deep in the vaults of MMFs earning a boring but consistent 4.5%. Let's not ignore the darker undertone here. With real inflation still hovering between 3.5% and 4%, your stunning 4.52% returns are, well, they're barely beating inflation. So what's the hidden price of these returns? We're losing net purchasing power. Investors are standing still, effectively treading water. Sure, cash hoarders aren't sinking, but they're definitely not moving forward either. This hesitation by retail investors and corporations to shuffle funds into more productive, higher yield, but riskier, investments like stocks, property, or bonds means that the money essentially stops refreshing the broader economy, causing an economic gridlock. Besides, climbing into money market funds is not a sign of prosperity, people. It's a sign of aggregate insecurity. So where does this leave us as we face down the uncertain beast of 2025? Step back and look at the larger economic context. The Federal Reserve is cautious, holding off on slashing rates any further after seeing the tide of cash heading straight into MMFs. Economists like those at Apollo Global and JP Morgan are forecasting that, eventually, this inflow will taper, but by late 2025, at best. The other major wildcard here is political restructuring. With Trump's re-election and his administration's perceived softer antitrust stance, corporations might just start releasing that cash from MMFs to fuel a new wave of mergers and acquisitions. The lure of relaxed regulatory frameworks might be the jolt needed to reactivate cash flow towards higher profit ventures. As rates ultimately tick down below 2%, if we get there, corporate America won't just let their giant cash balloons float idly in MMFs. They'll redirect it to more lucrative avenues, like M&A, for a chance to make some serious returns. But for now, money market funds are the darling of a cautious, wary market. Investors are skeptical, they're unsure about future stock market bouncebacks, and the bond market doesn't hold the allure of yesteryears. Meanwhile, money market funds seem like the safest, sturdiest house on the block. Until there's greater economic stability, cash will likely keep flowing. So where does this leave the world of finance and economic management? The predicted exodus never came because we're living in a shadow economy where safety reigns supreme and risk is avoided like the plague. Even as rates tick lower, investors remain glued to their cash reserves, unwilling to entrust their money to longer-term uncertain assets.